Here are some examples of risk management commonly used in trading. Risk management is a crucial aspect of trading. This allows you to protect your capital and minimize your loss. Number one is position sizing. It is important to determine ahead before you take a trade the size of your position before you even start taking this trade. A general rule is do not expose more than 1 to 2% of your capital. The second rule is the one everybody probably know about, but most beginners don't use, is the use of stop losses. But they give you the opportunity to define ahead what amount of loss you are willing to take if ever a trade turn against you. Now, the third one is take profit order, commonly known as target price. So whenever you open a trade, there is some element that you need to be very clear about. We have a video about that coming, and one of them is you have to have an idea of where you will be comfortable enough when you open. Once your trade is open, you need to know exactly where you will be comfortable enough to take profit. The fourth technique commonly used in trading to protect or in risk management is trailing stop. Now, some platform offers the opportunity to have a trailing stop based on price or based on percentage. So let's say that you are in a long position, you're buying, and then price is going up. You can say that if price dropped by 1% from the last close, you're gonna exit. So the stop loss follow, it's a type of order that follow the price, the actual price of the asset you're trading, and then will readjust the price of the order based on the actual evolution of your asset price. The fifth principle is very controversial. Some people like it, some don't, but is diversification. Diversification inside the market you're trading, diversification in your life as an investor in general. On top of being diversified in the markets, for an example, crypto market or stock market, you have to be diversified as a general rule, like invest in real estate, that kind of stuff. But when it comes to trading or investing, we refer to diversification as spreading your investment to a different type of industry, maybe tech related, housing related. So spread your investment so you can minimize the risk and do not be affected if one sector of the market decide to go south and all your investment is in one spot. The seventh rule is something that lots of traders, beginners, I'll say, don't use, is a risk limit. Now, there's different way to set up your risk limit. For an example, when it comes to me, I do not trade per order. I trade per sets of order. So I trade sets of 10, sets of 20. Might readjust based on the market trend or based on my life in general. If I'm gonna be very busy in the next 2 to 3 months, I adjust the amount of trade I'm gonna consider a full set. So a full set of 10, 20 trade per month. So this is your risk limit. In that risk limit strategy, you need to have a certain amount of losing trade you are willing to take before you stop and calm down and slow down your trade. For an example, if you have a set of 5 losing trade, generally this might affect you psychologically. This is the moment to stop, take a break as long as you need to get back in the market confidently. This kind of thing happen to the best of us. Now, the 8th point is over leveraging. Now, in the United States, leverage is not commonly available for every investor, but this is something that is not fully regulated in many countries around the world. So if you are part of this country, I know for a fact that you have no such regulation over leverage, and that might put your portfolio at very risk. If you're gonna make use of margin trade, that we usually call it margin trade, you have to be clear about over leveraging. I remember back in the days when BitMEX was available in the United States, they were offering 100 times leverage on Bitcoin, and back then Bitcoin was very less regulated than it is today. So this is this is the type of tools, this is the type of leverage that is not manageable by all type of trader. But if you're gonna make use of leverage, make sure that you have your personal condition and principle, that you have sets of rules to not over leverage yourself. Now, number 9 on those techniques of risk management is not something that I commonly support. It's called backtesting or paper trading. Personally, I don't think a trader is fully exposed to the full force of the emotional load when you're trading real money. But we have to talk about it. It is not all traders are the same. We don't have the same risk tolerance, and we don't have the same mental. We don't have the same mental strength. So for some people, I know some people that use paper trading and backtesting as a principle in their trade. But I personally, I don't do backtesting. If I'm interested in trying a strategy and see how it works, I might set up an account specially for that, a certain amount of money specially for that, and then I'm gonna set source trade especially for that, and then test it. But it has to be real money for me. But this is something you need to know about. Whenever as a trader, you will have to invest in your education continuously and invest in your learning. And whenever you have new information, new trading strategies, and new theory that you would like to try, you have the opportunity to backtest or paper trade, or you can set a certain amount of money just for that specially. It really depends on how you identify yourself in terms of psychology. The number 10 is you have to be aware of event commonly known as fundamental analysis. Now, my trade are 100% based on technical analysis, but I do have some other YouTubers and other people that I follow because I know they are highly fundamental analysis. I also have some financial advisors that are good friend of mine that we've been doing business for ages. So whenever I need some kind of, if I can say, fundamental profile, or I go to them and ask them to take a look at this or take a look at that. So I'm not really into to dig into the news the way that I see them digging into the news and events, being aware of. So for me, it's 100% technical analysis, but I do have a group of people that I personally use as, if I can say, fundamental analysis, personal references. And then I'm going to give you 2 points. I'm going to give you 2 more bonuses. The first bonus is always try to gauge your exposition based on the market volatility. Adjust your trade and your exposition based on the market volatility. And this is something that I've learned by practicing. When I first started trading stocks heavily a lot, I did not realize that trading dividend stocks and trading growth stocks are 2 different things. As I'm trading over the years, then I realized that growth stocks seem to be more volatile than dividend stock. And with that being said, whenever I have a possible entry or exit, I have to readjust myself and I have to calculate my portfolio exposition based on the type of stock. So that's one thing. And then I realized that some other market, especially cryptocurrency, the bigger the market cap, the less volatility, even though there's a lot of volatility in this market itself. So this is one of the reasons why it is very important for you as a trader to have a general sentiment about the market you choose to trade, or we can say you choose to evaluate. The second bonus I'm gonna give you is be aware of market correlation. Now, this one, some people know about it, some people don't. You might miss it if you only trade in one market. Generally, one market usually affects the other. For example, a market in a country might affect another market, and then inside of this market, different industries, they affect others. So you might be in a bear market in cryptocurrency where every single coins or crypto projects are dropping by 70 to 90%. In the stock market, you have a little bit of correction, that looks more healthy and more promising. So in the other thing is the same example of dividend and growth stocks. A lot of the time when a group of them are dropping, the other group does not. Or in different kind of growth stocks, you have stocks that are around a certain type. For example, you can have stocks that are in healthcare, they stay stable, while stock in technology are tanking. They are tanking and they're dropping, while stock in technology, tech industries is dropping seriously. So these are the things that you learn to incorporate on your trade or investment journey, and that will be it. We have more videos coming, and we are in the process of rebuilding the entire free class that we uploaded 3 to 4 years ago, because I believe that we can have you can still watch those free classes. There are over 100 hours of free classes. We do this entire thing will take some time. We will rebuild the entire free trading class that we have on this channel, and we're gonna have more details and certainly more chart than the previous one. Remember, you subscribe, you like, and then I'd like you to comment about what type of things you would like to learn. And most importantly, as if you are actively trading, I'd like to know what aspect of trading have put your portfolio at risk, or the struggle you're dealing with. Put everything on the comments, because I'll use them as ideas and references to create more content for you in order for you to learn. All right, take care. Bye bye.